Hello, welcome to Adventure Terrain Ventures. I'm Oral David here. So today we are going to continue our discussion which we had on the last video about trading styles. So we did discuss in the last video about the various different trading styles that you can adapt. Okay, and today we'll just go a little more deeper into the trading style intraday, or we call that as day trading. So what is day trading? So as the name suggests, the trade that lasts for a day, we call them as day trading. You buy in the morning and sell it off the same day before the market closes. So that's basically day trading. Now, what is the reason why people would like to do day trading? The number one advantage with day trading is that you are out of your trades by the end of the day. In other words, you go to sleep with a lot of peace in mind. You don't really have to worry what's going to happen to the market tomorrow because you don't have any position open for the next day. And with day trading or with intraday trading, you could trade both directions of the market. That means if you are expecting an up move in the market, you can buy first and sell later, what we call as a long position. And if you are bearish on markets, that means if you are expecting prices to drop, you can sell first and buy later. And that's what we call taking a short position. So intraday style of trading is good for beginners. Now you may be hearing this and saying it's quite different what is contrarily believed in the market, or generally what people say, that intraday trading is very risky. But I would say the opposite. Actually, intraday trading is the least risky if done properly. And it's definitely the very first style of trading that a newbie or a beginner should get into. Of course, if you're planning to get to only investments, then it's a different story. You're not getting into trading at all. Okay, if you're an investor, then you're only investing in stocks for long term. And there's no question of really even attempting intraday trading or day trading. However, if you're a trader, even if you plan to be a positional trader, or if you plan to be a swing trader, and if you're just trying to learn trading, then it's better, you're well off starting as a day trader and then graduating to a swing trader and then thereon to a position trader. The reason is because in day trading, you can actually manage your risks very well. And you can manage your risks with stop losses. So it's possible to take a very small risk in the beginning and do your day trading. Unlike the case of a swing trade or a position trade where the trade may gap against you and you could lose much more than you initially planned for, or you could lose much more than your actual risk appetite. It's always advisable for a newbie or for a beginner to trade with very less risk and with a very less capital, because the chances of losing at the time of learning is very high. Almost everyone loses at the time of learning. It is the loss that actually gives us the learning. So it's better you lose small than you put in a large capital, lose big, and then you almost have to earn back your capital, and then it takes much longer to earn back what you have lost. So day trading would be ideal for beginners, one, because you can take a small risk, and secondly, you get your results faster. Now, to get a result of a position trade, you might have to wait for 2-3 months. So your learning curve becomes that much longer, because by the time you start seeing the results, you might have to wait for about 2-3 years. Whereas if you are day trading, you get the result on your same day. So if you are not doing something right, and if you need to change your approach, you have you get your results very soon, so you can make changes to your trading strategy. So on the whole, I love intraday trading. Even now I do a lot of intraday trading, and for people with a small capital, intraday trading would be ideal, because you can trade both directions with a small capital. If you are doing position trading, and if you want to trade both directions, you can't do it with equity. You have to do it with futures or with options. And then futures and options do require you to have a larger capital because of the lot size. Now, equities don't have a lot size. You can trade 1, 2, or 3 stock as well. So even with people with a small capital can do day trading and earn from it. Let me share a couple of points to bear in mind while you day trade. Choosing the right stock to day trade. While you choose the stock to day trade, use a stock, or always trade a stock which is having very good liquidity. So I usually look for stocks which are trading at least on an average more than 5 lakh shares per day. So you can use that as your criteria to select stocks that are liquid. My broker, that is Sher Khan, has a list of stocks called the big trade list. So what you see here is the big trade list. Now what they have done is they have selected stocks that are liquid, and they have made a list. On this list, Sher Khan allows you to trade with a 10 times exposure. Now what does 10 times exposure mean? It only means that if you have, say, about 1,000 in your account, you can buy up to 10,000 rupees worth of these shares. Now, it's not always advisable to use this exposure to the maximum, because exposure is a two-edged sword. It can give you a good profit, or it can even cut you, right? So it's very important that you don't over trade or do not utilize the full exposure. So how do you decide how much of quantity to trade or how many shares to trade? It all depends. It should always depend on your capital and not the amount of exposure your broker gives you. So it is a fact. Capital is one of the factors. The trade that you're trading itself, that is the entry price to the stop loss, which we call the risk, is another factor. So if you have a small stop loss, you can go for a larger quantity. If you have a big stop loss, you should go for a smaller quantity. So just to give you an example, here is a trade which I took this week. So in this trade, this is MRPL on a 15-minute chart. I'm going short at 78.65, and I have kept my stop loss at 79.3. So it is a risk of 65 rupees, or sorry, a risk of 65 paise per share. So in one share, I'm going to lose 65 in case my stop loss gets hit, 65 paise. So all I have to bear in mind is my quantity. When I calculate my quantity, I should not be losing more than 1% of my total capital. So though my broker would give me a 10 times exposure, I would rather utilize only 2 or 3 times depending on my trade plan, the trade that I have planned. Let me just go show you this trade which I took this week, MRPL. Now this trade was a stopped out trade for me. So it's not that every trade goes in a profit. Okay, there are sometimes the trades go in a loss. But the beauty of this trade is, though it is a stopped out trade, I never lost any money in this trade. And let me show you the reason why I didn't lose any money in this trade. Now what you see on this chart is a drop, a period of pause, and a drop, sharp drop down. So this zone here is my area of supply. My entry price 78.65, my stop loss 79.3, just above the area of supply. So this trade I had planned just yesterday, and I got my fill this morning itself, early in the morning. As you can see, the price went right through my area of supply. It looked as if that supply never even existed. But then let's look at it little closely on a 1 minute chart. This is a 15-minute chart. I'm going down to a 1 minute chart to see what actually happened early in the morning today in MRPL. So this is a 1 minute chart. So let me just find my trade here. Yeah, exactly. So this is the point where I got my fill. So let me just zoom into this area to see exactly what happened. Let's zoom in a little more. Right. Now it's a bit more clearly visible. You can make out what really happened. So the very first minute, I got my fill here. This is where MRPL entered the zone. But what really happened after it entered the zone, it immediately came down. It came down till about here. Let's see what price point that is. Till about 77.95. Let me just change this line to 78. I'll tell you the reason why I've changed it to 78. You can see price coming and touching this price of 78 and then moving up and then going and violating this area of supply. So did price move up as if there was no supply at all? Not really. It did give a bounce from this area of supply, and then it went and breached the supply. But all this happened in a span of 1, 2, 3, 4, 5, 6, 7, 8 minutes. So that's why on a 15-minute candle, the very first candle shows you that the zone has been breached. So all this detail cannot be seen on a 15-minute candle. Now, why did I get into all this 1 minute and show you this? oops, this is a 10-minute. Let me go to a 15-minute. Yes. So this is a 15-minute candle. So in the 15-minute candle, you can't see all the detail, the bounce and things like that. But the reason I didn't lose on this trade is because of a rule that I follow. Now let me share what that rule is. Whenever I get entry on my trade, and if price moves in my favor, in this case it is down, and if price moves to the extent of the risk that I've taken, the risk that I've taken is 65 paise, and if price moves down 65 paise, which is 78, which is 78.65 minus 65 paise, that is 78. So moment price touched 78, I trailed my stop loss from entry from my original stop loss price of 79.3 to my entry price of 78.65. So let me just repeat that again. The moment price moved in my favor and it touched 78, which is equal to the risk that I have taken, that means price has moved 65 paise down, I moved my stop loss from 79.3 to my entry price, which is 78.65. Why did I do that? By doing that, this trade becomes a no risk trade for me. So in case price came down and achieved my target, I still get my target. But in case price turned and started moving up, I'll be out at no profit, no loss. So this is what I call a break-even trade. So as soon as possible, I try to make my trades a break-even trade so that I don't have any risk in my trade. So that's the reason it gave a bounce till 78 and then bounced up. So moment it touched 78, I trailed my stop loss. So when market went up, I was stopped out at break-even point. So that's the reason I never lost anything on this trade. So these are the things which are required to be done while you do your day trading. And as soon as possible, even though it's a stopped out trade, you don't really end up making any huge loss. Another interesting point that I would like to share here about day trading or intraday trading is the ability to place bracket orders. So what are these bracket orders? Now my broker, that is Sher Khan, provides me bracket order facility, which not all brokers do, but very few brokers do that. So how do I actually place a bracket order? If MRPL is the trade that I'm trying to do and I want to go short, so I have to right click on MRPL and choose sell script. Yeah, and I get my sell order screen. Now on this sell order screen, I have a pull down here which says a bracket. Now what really opened up here is a facility to place a stop loss and a target all on one single screen. So with this bracket order, I can place my entry price, which I have to enter over here. I have to give my stop loss, which I enter over here, and I have to give my target price, which I enter over here. So all these three orders can be pushed at one single push which can even be done early in the morning before market starts. You don't have to wait for markets to be open to place these orders. They can be placed as after our orders. And I'm set for the day. So all I have to do is plan the trade with my entry, stop and target, place the order, and then I'm set for the day. I don't really have to monitor this trade during the day. So this is how I manage stress in intraday trading. I don't really need to get too stressed out. Most people I see, they get very stressed out with day trading because they have to keep looking at the charts every now and then. But when I place bracket orders, I'm not stressed out because I can relax, knowing fully well that if after my entry takes place, on automatically my stop loss and target orders are in place, and if one of them gets executed, the other one gets automatically cancelled. So this is the way you can manage stress. It's always advisable you use bracket orders while you are day trading. Let us now look at the chart of Nifty and see what is the market expected to do this week. So far we had a very exciting week where markets are now hovering almost close to its historic highs, right? And we saw a nice up move in the last couple of days. Can this uptrend sustain? Do we expect some corrections? That's what we're going to see. So in my last video, we discussed about this supply zone. And as you can see, prices just touched that supply zone and then dropped all the way to the demand zone within a day. And next day, again, prices rose from the demand zone and breached this area of supply. So since the supply area has been breached, we'll now get rid of this supply zone. There is no more supply anymore once a level has been breached. Now let us look for any more area of supply. Since price is over here, we have to look for supply above current market price. So above current market price, we have this area of supply. So as you can see, there is a period of drop, a pause, and then a very sharp drop down. So this can be a potential area of supply, the next potential area of supply. However, this area of supply has been tested before. You see here, price has touched it and then fallen very sharply. Again, price has touched it and then fallen very sharply. So we have price touching this area of supply or testing this area of supply 2 times. So the third time when price got into this area of supply, we have gone very deep into the zone. Probably you may see market dropping from here, or it may even break this area of supply and go higher. Okay, so usually I don't try to predict the market when price is entering an area of supply which has been tested twice before, because the probability of this supply holding now has come down considerably. So there is I wouldn't be surprised if price just broke this area of supply and went higher. And we don't have any more areas of supply because we are at or will be at historic highs in the market. Even if price drop down, I would not try to take advantage of that fall because this is not a very strong area of supply anymore. So it's a no trade zone for Nifty right now. We can't take any trades in the Nifty. All we have to do is wait and watch. I would like to wait to see if prices will drop down into any of these areas of demand. So we do have one demand over here. This is a newly formed demand. Okay, so since this demand has been formed and since this demand is not violated but it is tested already, so let's get rid of this demand. We do have some demand here as well, but I would not want to lean on those areas of demand, but this area of demand I would be quite happy to lean on. So I would want to wait and see if prices will come down to this area of demand and then only try to plan any trades on the Nifty. By looking at higher time frames in the Nifty, you can, when we go to the monthly chart, you can see the price has been trending strongly up and there are no area of supply at all. So overall, we are bullish. If you go to a weekly chart, in a weekly also, this is not an area of supply in the weekly chart. And that's another reason why I don't consider this daily support, daily resistance or daily supply as very strong, because it's not visible in a weekly chart. There is only a rally and then a drop. There is no pause, right? So we need a period of pause to really call that supply. So since we do not have supply on a weekly, there's a good possibility that price can go and breach this daily supply area. So that's all we have time for today. Thanks for joining me. My name is Aurel David. To get more information about our courses or anything about the markets, you can visit our website, that is adventureterrainventures.co.in. Thank you and thanks for joining.